Good afternoon. I'm Leon Metzger. We'll try to make this panel as exciting as Jim Simons if we can. The topic is valuations. I'm not sure if we can really do that, but we'll try our best. Our panel is, to my far left is Mark Anson, in the middle is Mike Greenstein, and to my immediate left is David Woodhouse. We have a panel with a different background. Mark is an investor, Mike is a service provider, and David is at a fund. And so we want to try to go ahead and talk about some operational issues as it relates to valuations. And we asked a polling question, and many of you responded, but I'm not going to show you the results yet because I want to go ahead and poll our panel and ask them for the results, what they think, at what time should securities be valued for a New York-based hedge fund. David, perhaps you want to start?
Well, I could duck the question by saying whatever the partnership agreement says, but I would probably go for midnight out of those four.
You pick midnight?
For a fund that was just US based, I don't know at the time.
New York based, let's say. And why would you pick midnight?
Because I think that gives you the, if anything, it's perhaps unlikely, but if anything were to happen after trading hours that might have an effect on the price, and your year end is actually, say, the 31st of December, then the auditor can take that into account.
So if it's a U.S.-based fund trading a security in Japan and the market is open in Japan, you would then use the next day's price, if you will. Let's say it might be at midnight in New York might be, in Asia, 3 p.m.
I think it gets a bit more difficult if you're trading in all three time zones.
But you're going to be using always, if it's a New York-based hedge fund, you will use the midnight price. Mike?
I guess I'd actually go with David's first answer, which is it could depend on the governing documents of the fund, because I don't think there is a technically absolute answer here. But if I was forced to choose one of them, I'd say A, 4 p.m. However, I would consider information subsequent to that, depending on the market and events that may have occurred.
So that would be, you mean if there's a one-off situation? In general, you would go ahead and say 4 p.m., but if there was a significant event overseas, but if it were not a significant event overseas, you'd stay with 4 p.m.
Correct.
And Mark, how about you?
You know what, I say we bring back Jim Simons and ask him. I think I'd be fascinated to find out, given how many securities he said he had in his portfolio, how he values them, particularly as he indicated that he invested in a lot of international positions. My own view is 12 midnight. A lot of trading goes on after hours, after the close of stock exchanges in the U.S. There's still quite a bit of trading going on in the tertiary market, so I'd say you close it off at midnight, and that in itself is arbitrary. You can say 1 a.m., 2 a.m., but you got to pick one point, and I think end of calendar day is as logical as any.
Not dusk.
Not dusk. I say that for special occasions.
Interestingly, I showed this question recently to some partners. I guess they're called now assurance partners. They're no longer called audit partners. And the assurance partners from the same accounting firm, they actually disagreed as to when. Let me show you what the group said. So 106 voted, 43% said 4 p.m., 10 said midnight, 32 the latest closing price on that day, and 15 the last traded price.
And the other comment I'd make, and I am an assurance partner from PricewaterhouseCoopers, and it was a different firm that Leon was referring to, but there is no, from my perspective, I don't think there's necessarily a right or wrong answer here. 4 p.m. is a historical time for registered investment products, and therefore I think that is somewhat of the default, and it's also the time at which a lot of the pricing services provide their, when they provide pricing feeds, it's as of 4 p.m. close. So I think, operationally, that's when much of the pricing information is being provided to a fund.
But Mike, you actually, I thought, disagreed with David, because David said you got to be consistent, you got to follow the agreement, and maybe you're suggesting that the agreement should allow for flexibility?
Well, I think agreements always allow for flexibility, and frankly, the industry has been criticized for that to some extent, but I don't think you could have a bright line for this specific issue. I mean, if you may have a security trading overseas and there may be development or announcement or some event that took place after, prior to 4 o'clock, but after the close of that market, and I think that should be considered, at least considered, in the fair valuation of that portfolio.
David, do you agree with that?
Well, I think what we're talking about is a tension. Valuation is full of these tensions between consistency and flexibility. In the sense, you want to have the cut-off consistent. Obviously, many abuses of valuation occur when you're abusing the cut-off. On the other hand, if you apply that absolutely religiously, there can be occasions where you'd be mistaken to do so because you're not taking account of all the facts.
So David, you do allow for flexibility? I mean, you approve?
Well,
I'm going to pin you down to an answer.
well, I think we would
Jim Simons gave answers.
He did. He didn't tell us how he valued his portfolio, though, and he didn't tell us how his models worked, which is why we all attended.
Well, we didn't ask him any valuations questions.
But I think you would, with an auditor sitting to my left, you'd fall on the side of consistency in normal circumstances.
And so, Mark, you have the final word on the flexibility question.
There's tremendous power in the hands of a hedge fund manager to price their portfolios, even if they delegate it to an administrator. Many times, particularly for illiquid investments, many times those hedge fund managers get their price quotes to the administrator late. You have to allow some flexibility. In the course of a trading day, it's not always easy to get the portfolio priced at a very precise time. So I give the hedge fund manager the benefit of the doubt, providing you've got confidence that they're doing the right thing.
Can I just add, although Mark had the last word, I think the question, just to clarify, is not when the NAV needs to be struck. It's as of what time do you obtain prices. So it's pricing as of 4 o'clock. Obviously, the pricing of the portfolio will happen subsequent to that. Mechanically, it has to, including prices for which you're not getting closing or published information that obviously could happen subsequent. This is really for listed securities. At what time do you pull in closing or composite pricing?
All right, I should have let the audience know that our panelists do not know the answers, at least the results of the polls. I do know the answers, so I decided I would ask them the questions so they wouldn't be biased by what you said. I see there's a question in the audience. Is there a microphone? Yeah, here's a microphone. Gentleman in the white shirt.
Isn't synchronous pricing very important? I don't know that it matters what time of day, but I would think important features would be you could price most of your assets around the time you take the snapshot. I think valuation, it's as of a particular time. So for instance, the midnight, there's probably a number of assets that weren't priced near then. Similarly with the closing for that day and last, particularly if you have multiple asset types, like maybe your options and you have underlying stock positions, that if you get a few minutes off, you can get some weird things going on. So,
was that a question or was that?
Well, the question is, I didn't hear anybody. As a criteria for selecting a point, mention synchronous pricing being available. 4 p.m. it tends to be a heavily traded time of the day coming into that time, and most of the assets are available, with prices at that time.
You raise a good point. The great thing about 4 p.m. is it's a great pocket of liquidity. So the price you get there is as accurate as any other point during the day. Just simply the fact of the matter is prices don't, or the last trades don't always take place at 4 p.m. And as a result, you may not have synchronous pricing because you don't have synchronous trading. And therein lies, the problem with the hedge fund world in general is they're not closing their books or closing their trading at the end of the day. It'd be great if they could. That'd make life easier for all of us investors, but it's not always the reality we hope for.
What are some guidelines, or how should someone go about pricing less liquid securities? Anyone? And we'll start with Mike this time.
Sure. Fundamentally, as I'm not, the auditor here, so maybe the only accountant in the room. I may have a simple view of this, but fundamentally, valuation to me is a function of methodology, inputs, and assumptions. And I think that it's important that managers basically have prescribed policies and procedures governing the choices of appropriate methodologies and inputs and assumptions. And I would suggest that they mostly do, but I would also suggest that the documentation of that and the formality with which they exercise that probably could be enhanced in many situations. And so, I'm a big proponent of detailed policies and procedures because I think the process of going through them and creating them is a healthy process.
That means written, correct?
Written policies and procedures, and an excerpt from your offering document is not a policy and procedure, regardless of what some people may think. So real policies and procedures, and policies are different than procedures, should be written down and
So if you had
basically lived by.
So if you had a policy which was any illiquid security will bring to the valuation committee, is that considered an acceptable policy?
Well, I think that would essentially be a procedure. I think the policy would be how they evaluate the appropriate methodology and inputs and assumptions for that security, which obviously depends on the characteristics of the security. I think as much independence as could be brought to bear on the process is certainly an objective, and independence could be defined broadly, recognizing that for illiquid or hard-to-price securities, the administrator, frankly, isn't going to add a lot to the process. They're going to rely, to a large extent, on information that's provided to them by the manager. And so if you don't have independence from that perspective, you need as much independence as you can from an internal perspective through the use of some kind of valuation committee.
David or Mark, anything you want to add?
Let's just take an example. Let's take mortgage-backed securities. The typical way you price those, they're less liquid, is the administrator should go out and get 3 prices, poll the market. Fact of the matter is generally it's the hedge fund manager that goes out and gets the prices, and those prices then get conveyed to the administrator. Is there independence there? Well, you have to argue not. But how else are you going to price these mortgage-backed securities in an efficient manner? I think what it really comes down to is the fact that when you do due diligence on a hedge fund manager and they trade in less liquid securities, so let's say they're trading anything other than stocks, what you want to look for is a pricing procedures manual. Forget about their offering memorandum, because we know that has so much legal jargon in it that it's basically there to protect the hedge fund manager. What you really want to know is how do they go about pricing those illiquid securities? What is the policy by which they establish the valuation, and then what's the procedure by which they price them on a daily, weekly, monthly basis? And so when we do analysis, when we do our due diligence on a hedge fund manager, it's one of the things we look for. Where is their pricing procedures manual? And if they don't have one, that's one of our key suggestions. Well, you should get one. Certainly before we put out our money, that's one of the things we look for.
Without exception, Mark?
Without exception. If a hedge fund manager can't tell you how they price the securities, how are you going to know what the hell the value is investing in that hedge fund?
Let me just comment on what Mark said. I mean, I agree. That happens all the time when there are broker quotes that are used as either support to derive a value or as support to corroborate a value. And let me just describe, if I can, what we would do as auditors, and I think administrators, frankly, or someone in the price verification group could do the same thing as a check on the manager. I mean, it's clear that the managers, the portfolio manager, the trader, are the ones who are essentially identifying the parties from whom they're going to, get quotes, right? They're really the only ones in a position, in the best position, to know who is qualified, if that's the right term, to provide a quote. But that doesn't mean that shouldn't be challenged, and challenged could be through a number of means. For example, are they getting a quote from the same 3 parties every period? Right? Who are they getting a quote from a firm? Getting a quote from Goldman Sachs doesn't mean that it's the same quality. I mean, you can get a quote from the institutional sales desk. You can get a quote from internal audit after having gone through their quality control procedures. I would argue that there's different quality, or at least different quality control that is brought to bear in those 2 situations. Are you getting a quote from a party that you've actually transacted with? Well, one of the things that we do is we compare the quote providers to the parties that they've actually done transactions with. If you're executing transactions with a party that you're not getting a quote from, well, that would be a red flag to me. When you actually have a real transaction, who was it with, and how did it compare to the most recent quote? So there's a lot of things that auditors do, or could do, or administrators do, or could do, to essentially corroborate the sources of quotes, but inherently it is the manager who is in the first position of directing where that price is coming from.
Well, Mike's covered most of the points on broker quotes, where the cherry picking of quotes is what people are worried about. I have to say, certainly in Europe, I think we'd expect the administrator to be involved in that process, perhaps not actually procuring the quotes in all cases, but certainly providing some kind of control. So if it doesn't come off a Bloomberg machine, you're either going to be going to quotes or to models. Now, some models, of course, will be mathematical models for complex derivatives. Others will, frankly, be models generated by the investment manager for quasi-private equity positions. And I think there, one of the key things is the materiality of the positions. If they are material, we keep hearing that hedge funds aren't very volatile. One of the reasons they're not very volatile is that the manager has scope to smooth pricing in those kind of areas. So, again, I think the trend, the corporate governance trend, is if that portion of the portfolio is material, admittedly there'll be some expenses for investors potentially, but that some independent party should be examining those models. We're coming probably to another tension in the process between the competence of the people doing the valuation and the independence of the people checking it. The other solution to all these issues, which we'll probably come on to a bit later on, is side pockets, of course. If you side pocket the position, then the mark-to-market issue each month, it doesn't fall away, but it becomes... Sorry? Side pockets. Yeah, so what some hedge funds do to solve to address the problem of there being very subjective positions in their portfolios is to say, I will segregate that from my main portfolio and treat it. They don't take an incentive. Well, most of them don't take an incentive fee till that position has actually been realised. But they'll treat that as a separate little pot, and not take an incentive fee on it until that position is crystallised. So in some senses, that means they don't have to worry about marking it to market accurately every month. There are also some advantages in terms of these positions tend to be J-curved in nature, so you don't get someone coming in like the prodigal son and taking a lot of the profit at the end. On the other hand, they're very difficult to administer, and obviously there is a motivation for people to dump impaired assets into those side pockets and hope that the investors forget all about the fact that although their fund has gone up 20%, the two side pockets have gone down 7%, for example. But that, I think, it would be fair to say, has become a lot more common, I think. And funnily enough, even in hedge funds that perhaps only typically would have 3 or 4% of their portfolio in a liquid or difficult to value positions, some of those funds, particularly in recent times, will side pocket those positions.
But I'll try to trip you up on that question in a few minutes. Don't worry, David.
Okay, good.
So let's talk about George Mitchell for a moment. For those of you who don't know who George Mitchell is, besides being the former senator from the state of Maine, when there's a problem in Ireland, he's sent in as a peacemaker. When there's turmoil in the boardroom at Disney, he's sent in to try to put out the fire there. If someone can discover which baseball players, which Major League Baseball players are using steroids, George Mitchell's your man. George Mitchell, I don't think anyone would disagree with me that George Mitchell is a person who's independent. I don't know how knowledgeable he would be, however, marking, let's say, mortgage-backed securities or some really second-generation derivative, something really complex. He's just not that knowledgeable, sophisticated. Now, sometimes, by the way, in Great Britain, they call it competence. Here we call it knowledge and sophistication in the United States, so we know we're all on the same page. So what happens if you really have a security that if you find there really isn't someone who's independent, and the so-called independent people are people who you wouldn't want to see because they trade against you? What do you do when you have that conflict between independence and knowledge and sophistication, or independence and competence? Maybe we'll start with Mark this time.
Well, you just laid out the classic issue. In theory, the administrator is independent.
If you're using an administrator, Mark.
If you're using an administrator. But let's assume...
How many people in the room, their funds use an independent administrator to value? And how many don't? Okay, so most people aren't attached to a fund, I suppose, or they just don't want to answer the question. because they're afraid they'll be on the wrong side. Sorry.
But the administrator, the purpose of the administrator is independent price verification, but the knowledge resides with the hedge fund manager. Particularly if it's an liquid security, as we said before, that's get priced to a model, or has to go out to get price quotes from brokers, hopefully 3. And then you have to ask yourself, are they going back to the same 3 brokers every year? Are those the same 3 brokers they go golfing with? Are those the same 3 brokers that provide them with nice holiday baskets at the end of every year? There's all sorts of conflicts of interest, and the whole industry is rife with that. So it's very difficult for the illiquid instruments to get perfectly independent price quotes. And even if they were perfectly independent, you still have to realize that the knowledge of the true value of those rests with the hedge fund manager. That's why they're investing them in the first place. So you've got this tug of war, and it's a continual tug of war, particularly for investors worried about the independence of the valuation versus the knowledge base of the hedge fund managers, and presumably that hedge fund manager has a great knowledge base, and that's why you invested with him or her in the first place.
I mean, I guess I would sum it up this way. I mean, the stuff that an administrator could value for you is not the stuff that you worry about being valued. I mean, they're going to be able to value the easy stuff, and that's not really what you're worried about. They're not going to be able to value the stuff that you worry about. And so, not to diminish their role, but in effect, I see them as no more than a calculation agent as it relates to valuation and as it relates to valuation. For a long-short equity hedge fund, maybe they can do everything, but that's generally not what investors are worried about as it relates to valuation. I mean, the other trend, I mean, there's clearly, going back to something that David said, I mean, there's clearly a convergence of hedge fund and private equity fund strategies, and we are seeing more and more side pockets, which are in effect, mini private equity funds within a hedge fund structure. We're seeing hybrid structures. I mean, we're seeing a lot more, which is reflecting the convergence that exists in the marketplace. And one of the trends that we are seeing for hedge fund managers who are getting into less liquid assets is we're seeing them use third-party valuation firms. And there are, not necessarily maybe for mortgage backs, but I'm not as familiar with firms for that asset class, but for a private equity type asset class or for loans or others, there are several firms in the marketplace that are increasingly used by hedge fund managers on a periodic basis to either derive value or in most cases to corroborate the reasonableness of the value that the hedge fund manager is coming up with. And from an investor's point of view, I think the question is how much value or how much independence do they see in that role. It is someone on the outside. It's obviously someone that the hedge fund manager is paying, right? And then again, they're paying the auditor, and the auditor is supposed to be independent, so you have to draw the line somewhere. But we are seeing more and more use of third-party valuation specialists by hedge fund managers, if not just on the annual valuation or audit date, but on a quarterly basis or in some cases monthly basis.
I think there are 2 scenarios here. There's one where the manager admits to being 100% in control of the valuation process, what's called self-administration. No one put their hand up. Self-administration is a bit like self-abuse. No one likes to admit to doing it. And then there's the other sort of scenario where an independent administrator has some involvement in the process. Now, in both of those scenarios, George Mitchell is very well regarded in Great Britain for what he did in a very difficult situation in Ireland. I would prefer to see George Mitchell either as a director of the offshore fund or as some kind of officer in the general partner if it's a US onshore fund, or as a member of the valuation committee. Because even if George Mitchell has no clue how to value the thing, he will, I would hope, take some diligent steps. I mean, there's a question of how much he should be paid for that and what his liability is. So even George Mitchell might not agree to this role. But if he did, I would expect him to be taking some diligent steps, whereas I'm not saying that the majority of hedge fund managers don't take diligent steps, but the majority of valuation committees for self-administrating hedge funds have no independent member on them. It's hard for me to believe that if there was a crisis in that hedge fund, that these people, even if they're back office people or middle office people who are being paid by the owner of the fund, will not be susceptible to being influenced by the fund manager. And that's why I certainly think in Europe we expect to see some independent, be it a third-party firm or be it a director or some kind of committee, as protection. Because even, people say, oh, it's 100% long-short equity, it comes off a Bloomberg machine, therefore there can never be a problem. There have been examples of people abusing that very fact, and investors thinking, well, that's so easy to value that anyone can do it. And precisely because of that, some disreputable Ponzi schemes have in fact, massaged their valuations. So I think some form of independence is almost a prerequisite, it seems to me.
Let me ask you what each of you would do in the following situation from your various perspectives. A fund makes an investment in an asset. The asset appreciates over time. The manager collects incentive compensation on the mark-to-market gains, if you will, and now a lot of investors want to withdraw. And suddenly the manager says, you know what, this asset's really illiquid. I'm going to have to put that in a side pocket. How would you react to that? Mark?
Most negatively. It certainly wouldn't please me. Now, that investment should have been in the side pocket agreement to begin with. And then you have to quiz that hedge fund manager very carefully in a very tough manner. Why is that investment suddenly illiquid now, such that it needs to be put in the side pocket agreement when it wasn't illiquid before? There's a couple safeguards you have to look at for side pocket agreements. And a couple things we look at is a limit on the amount of the hedge fund that can be put into a side pocket. We normally look for a limit of 5 to 10%, depending on what the trading strategy is of the hedge fund manager. Second, we demand notice when anything goes into the side pocket agreement. The key thing you have to worry about there is just this point. Suddenly the hedge fund manager says, oh, this investment isn't worth as much anymore, and so they dump it into the side pocket agreement, and it just becomes a dumping ground for not only in their minds illiquid investments, but investments that have lost value. So we ask for notice before anything gets put into a side pocket agreement so we know, what's going into that side pocket. And the third, you need to establish the ground rules up front as to what goes into the side pocket, which is clearly not the case here in the example. There was nothing established up front, according to your example, Leanne, about what would go into the side pocket until the hedge fund manager decided he wants to dump it in there. Yes, they could be used for illiquid investments, but they could also be abused for investments that have lost their value. Let's take a stock. Not every stock trades every day. So if a stock has gone down in value and it didn't trade yesterday, does that mean it's now illiquid? Well, the hedge fund manager would probably like to make a case that it is and dump it in the side pocket agreement. You've got to hold the hedge fund manager's feet to the fire on these things.
We would actually redeem from a fund in that circumstance, but of course the problem is...
But you wouldn't be able to redeem
well,
the side
that's
pocket.
the problem. The damage has already been done. The thing that you're worried about, well, it would first be just the moral point of abusing their constitution. That would be why we'd redeem. But you're stuck potentially with side pockets that can go on for indeterminate lengths, and of course most fund of funds products, some pension funds may have a longer time frame, but tell their investors that they're going to give them quarterly or half-yearly liquidity, even monthly liquidity in some cases. How can they do that if they have a material allocation to side pockets? There are funds, admittedly quasi-private equity funds, that some are very good funds, I think, that have a potential of 100% allocation to side pockets. So the whole fund, in theory, I don't think it would be very unlikely it would ever happen, but the whole fund, in theory, could be made up of side pockets.
Do you object if the fund manager receives compensation for what's in the side pocket?
Well, the question of the flat management fee is quite a technical one. That can be, there are tax issues there, all sorts of treatments can be done there. On the incentive fee, we wouldn't expect the manager to take an incentive fee on a side pocket position until it crystallised. Of course, even if there aren't side pockets, you've still got these issues, and that you do have, I think, hedge funds who prefer not to side pocket can take a very prudent approach to their illiquid positions and tend to value them at cost, which of course follows the accounting concept of prudence, which we all learnt when we were at accounting school. On the other hand, that is unfair to people leaving the fund. If you've marked something at cost and you think the real value is the real fair value is twice cost, and I'm redeeming from the fund, I'm not going to get the fair value when I redeem. So even, side pockets are, I think, a way of trying to solve that issue, but there are still issues for any fund that has a liquid positions in their portfolio.
I mean, just from again, as the auditor here, I mean, the U.S. GAAP accounting rules that apply to side pockets are exactly the same as apply to non-side pocket investments. I mean, that is that investments need to be carried at fair value, period. Whether it's in a side pocket, whether it's in the main pool, whether it's in a private equity fund, or whatever. I mean, fair value is fair value. It is admittedly much more difficult to value private, illiquid securities, but but fair value is the standard. Doesn't mean that people don't argue that cost is a proxy for fair value, but they need to represent and support that the asset is at fair value. Going back to your question, Leon, I guess as the auditor, I'm not sure that if they're allowed to put something in a side pocket, I'm not sure that there's any action that I could necessarily take other than express my concern and maybe even sever a relationship if we find that a client is abusing or potentially abusing their side pocket provision. I would suspect we would sever that relationship. At the end of the day, a side pocket is about being fair to your investors, and we, for the most part, see it being used prudently, as opposed to being used, for abused. Thank you. But anytime there are movements to and from a side pocket, it's something that we focus on. And if you're going to buy, and I agree absolutely with Mark that there needs to be policies and procedures governing what goes into a side pocket, because not every illiquid investment goes into a side pocket. It could vary based on the type of asset. Some people distinguish between debt and equity for various reasons. It could be based on the size of it. They may have a de minimis level below which they won't put investments in a side pocket. But there are rules of the road that they should follow with respect to their side pocket allocations, because fundamentally it's a trade allocation. They're distinguishing certain group of investors from participating from other group of investors. And anytime you're moving something in and out, it certainly raises a question for us, and we would go back to the manager and understand what specific event, led them to move it in post-acquisition or move it out prior to ultimate realization.
Mark?
The last comment I would make is the example that you gave, Leon, is a perfect case in point why the hedge fund industry should have clawback provisions for incentive fees. Now, clawbacks are standard documentation terms in every private equity deal out there. Every private equity fund, whether it's venture capital, leveraged buyout, a mezz debt, or a distressed debt, has a clawback, i.e. that the investors in a fund can claw back some of the incentive fees if subsequently the value of those investments decline. The case in point you just gave us is a perfect demonstration of why a clawback would be necessary. But to prove how smart hedge fund managers are, they have taken the best deal terms from private equity funds and left the worst deal terms behind. In other words, they've brought lockups into the hedge fund space, which is a common term across every private equity deal, but they've left the clawback provisions behind.
Another point, Mark, is that these side pockets, of course, you don't have the netting off effect on the incentive fee, which is pretty cheeky, to be honest. So if you have 10 side pockets and 3 of them go bad, you don't get charged for that, but you receive the incentive fee on 7. Whereas if you had all those positions in a portfolio, the 3 bad ones would net off, the 3 losing trades would net off the 7 winning trades. So in that sense, side pockets are cheeky more than cheeky from a fee raising point of view.
Well, let's move on to the next polling question. Ultimately, who should be responsible for the valuations? And I'll poll our panel first. We'll start this time with David.
I actually don't think the right answer's on here, in that it depends on the structure of the fund. But I think
what's the right answer?
I think the right answer is either the directors of the offshore fund or the general partner. I admit that in most cases
that would be the fund manager.
Would be the fund manager, but I think most.
So which best? Which answers the question?
Out of the 5 you've given me, I would reluctantly say fund manager, but I would make the point that the majority of assets invested in hedge funds now are invested in offshore structures where there should be a board of directors, and we'll probably come on to that in a minute.
Yeah.
Mike?
Well, yeah, I would agree that the ultimate responsibility would sit with the board. The day-to-day responsibility would sit with the fund manager / general partner. It would clearly not, I'd have to say, clearly not be an auditor or a prime broker. Administrator obviously has a role, and trader is an employee of the fund manager, so it's part and parcel of the same thing.
So your answer is fund manager?
Yes.
And Mark?
Well, you put a key qualifier into this question, legally responsible. Now, I'm a lawyer, so the question comes down to who you're going to sue. And you're not going to sue the administrator, and furthermore, they're not going to take the legal liability for that, nor will the prime broker. I mean, anyone here ever read a prime broker agreement? Just wear Bear Stearns. I mean, not to pick on them, but they're not going to take responsibility. Certainly not the auditor or trader. So who are you going to sue? It's the fund manager. I think we're in agreement.
And here are the results. 50% of you voted for the fund manager, 22 administrator, 14 prime broker. Mike, you like this one. 12 for the auditor, and
Leave
3
now.
for the trader.
Actually, though, I'm curious, Leon, can we change the question back
Sure.
to who you're going to sue? And let's see what the poll is from the audience.
If they're willing to answer, well, they'll probably sue everyone, won't they?
I think so.
But if you had to choose one, who would you
Okay,
sue?
if you had to choose one, whom would you sue?
So start with fund manager. Let's see how many hands.
Fund manager? I'd say 75%. Administrator?
But only a desk.
Administrator?
Well, you're a hedge fund manager. Put your hand down.
I think you might well actually go for the prime broker because he's probably got the most.
The prime broker has the deep pockets.
Well, they may be indemnified
Okay.
and so forth.
Prime broker?
Because remember, if the fund manager, if it's gone wrong, there'll be nothing left in it. I mean, there'll be no money to.
I'll be honest, the prime broker probably has the least responsibility
Yeah,
out of
that's
that
right.
group. I mean, they should have no role, frankly, unless they're also serving as an administrator. They should have no role in the valuation.
But I think, yeah, I think this lady here in the row has got the right answer.
Microphone?
No,
Yeah,
but
it's
she's
not
got the right
relied
idea.
on.
Let's hear
It's
what
not, to be fair to the prime broker,
you-
I don't want to give the prime brokers a good time, but to be fair to them, they're not legally responsible for the price that goes in the NAV. That's an important difference. Now, I think some hedge funds, to be fair, do probably rely on their prime brokers' pricing, and they should. But I don't know of a prime broker who would legally agree that their pricing.
Well, do prime
Well, every
brokers
statement,
prime
every
brokers
statement
mark
says
to
don't
market,
rely
do
on
they?
valuation.
But prime brokers don't mark to market, they mark to protect themselves.
That is the paperwork the trades against. There's another statement between the fund manager and the prime broker.
Can everyone in the back hear what this lady is saying?
Pays them money.
Hold on.
That is, if
Wait.
you take
If you could
the
help
money
speak in the
as some
microphone.
kind of speech, then the prime broker is on the end of a contract where they're saying, I contribute something of value, and they have to go there and sit in front of a judge and say, the basis on which I was paid included no pricing at all, and that's where my bet is, that the judge is not gonna be convinced of that.
Well, prime brokers have definitely been sued in this area, as have administrators. But I think normally where the prime broker would lose is if it was something as on top of pricing. You know, that it wasn't just. I don't think he'd lose if he said I gave 100.
Show the value added. Yeah, it'd be an interesting trial.
I've got to, actually, I've got,
We agree in substance.
no, I want to twist this question just a bit more, just to have some fun with the audience. Now, we've all heard of capital introduction groups. Bear Stearns does it, Lehman Brothers does it, Goldman Sachs. So, suppose you met the hedge fund manager that you've invested in through one of these dating services, as I call them, a capital introduction group, through Goldman Sachs or Bear Stearns. So it's Bear Stearns who introduced the hedge fund manager to you. Maybe we could ask the audience again, if they were introduced to the hedge fund manager through one of the dating services, would they sue the dating service, i.e. the prime broker? I sure as heck would. I'd give it a shot.
Who would not?
Oh, yes, they did. They served me alcohol at the dating service. You bet they did.
Is the basis of the lawsuit strictly valuation?
I don't know. Leon, would you,
Fraud or-
you can change the hypothetical,
Well,
but
this
how
is-
would you change it?
Well, if there's some other type of fraud involved, that might change who you go after.
Oh, okay. Well, that's a good point.
This is the United States of America, and everyone has the constitutional right to sue.
Everybody.
You may not win necessarily, but you can sue.
We can make it one. All the above.
But of course, it's partly that culture that causes the problem, in the sense that many administrators are now reluctant to take any legal responsibility for pricing because they're frightened of being sued. Several have been, some successfully. People are petrified of going onto the boards of offshore funds unless they've got very good indemnity insurance. It's the suing culture that causes some of the problems. And you know, then you've got just to make a slightly separate point, I don't think we've touched upon this extraordinary corporate governance that an onshore hedge fund has, where the general partner, who's meant to be responsible for, has fiduciary duties to all other partners, is not only the fund manager, but in some cases can also be the person valuing the portfolio. I think in a more classic structure, you'd have 3 different people doing those jobs.
All right, we're going to go to another polling question now. We have 2 convertible ARB funds, A and B. They both exist since 1991. A's earn, on average, 18% per year, while B's earn 20%, but A's got better valuation policies, procedures, and practices, state of the art. B's not bad. I mean, it's average. It's not bad. But A is better, but A's earn less. And the question is, in which fund would you invest? We'll start with Mike.
Yeah, I'm not sure I'm the best person to answer this question. I mean, I would hope the answer is
We can see you, too.
is Fund A, especially because the differential is only 200 basis points. So I think it would be more interesting if it was maybe 15 versus 20 or 12 versus 20. But for 200 basis points, I think when you weigh in the risk-adjusted returns, I would hope it's A.
Mark?
You look at 18% versus 20%, you say, oh gosh, that's not much of a difference. But keep in mind, if you're an asset owner, an asset manager out there, you're fighting for every basis point you can get. And 200 basis points is still 200 basis points, no matter how you slice it and dice it. What I would do in these circumstances is I'd first look at convertible ARB fund and see if through my due diligence I can supplement the policies, procedures, and practices to find out just how legitimate their prices and valuations are. If I can't do that, then Fund B is out of there, and you've got to go with Fund A.
You're going to go with A? Okay. David?
I'd be interested to see the volatility of Fund B. I think if the volatility was low, it would suggest to me that the practices were sort of below average. But I think the answer on the evidence that we're provided with has to be A.
Okay, so the 3 of you say A. Now let's do the second question. In which fund do you think others would invest? We'll start with you, Mark.
I think people would choose A. They'd like the certainty of the operational background. They wouldn't want to take on the operational risk. It gets back to what David was saying. What's the volatility of Fund A versus Fund B? But there's not only the volatility, the valuations associated with the positions in which they trade, there's also the risk of lack of proper procedures and operations. And you have to ask yourself, do you want to take on that risk, and is it worth 200 basis points to you? In my mind, probably not.
David?
Well, you want me to answer B, don't you?
Yeah.
The way the question is set up. But
Yeah, what do you think other people do? What's
I
the
think
real
some
world?
people. I think some people genuinely do, and this Mark will be familiar with it as well. There's nothing, I think, wrong with this attitude to investing in any asset class, but hedge funds as well. As long as you tell people that's what you're doing.
Whoa, hold on a second. We got to.
No, I'm saying some
Are
people.
you saying hedge funds are an asset class? Are you saying that?
Let's not get into that argument today.
Pardon?
Let's not get into that argument today. The point I'm making is that some people will say, I just want the best return, and frankly, as long as I've got, as long as I don't think they're crooks, I will invest in the funds that I think will give me the best return. And as long as they're transparent about that, and that's what they say they do, then there's nothing, there it is. But I think they will be subject to blow-ups over the years if they take that approach. Whereas some of the people will say, never mind how good this fund is in terms of its returns, it does certain things, either in its fee structures or its valuation or other things, where I simply feel I can't invest.
So what do you think the majority of people would do?
Well, I genuinely think the majority of people, if they're responsible, would invest in Fund A.
In A, okay. Mike, you got the last word on this.
Well, I was answering the second question anyway, so yeah, I would say A.
Okay, so let me tell you that after the IAFE published its white paper and valuations a few years ago, I was asked to speak at an institutional investor conference where at the conference they had these anonymous voting buttons. I'm sure everyone in the audience is familiar with it. There were about 100 or 120 institutional investors there, and I asked these questions. So the audience went 50-50 on the first question. So about 50% went for A and 50% went for B. But when I asked them, how do you think others would invest, 90% said that people would invest in B, and only 10% would invest in A. That's what institutional investors thought of others back in 2004, 2005. Here's how you voted on the first question. 71% would invest in the lower returning fund, and 29% in the higher. And then the second question, the majority thought that more people would invest in the 20% fund than the 18% fund. It was pretty close, though. Statistically insignificant.
6 people didn't vote, I see, on the second question.
Yeah, 6 people did not vote. Now let's do another polling question. How much transparency should the fund give to investors? And you've got full, partial, limited for either valuations, policies, performance attributes, positions. Who wants to go first? David.
Well, I think the 2 documents that Mike and I have been involved with have a slight nuance on this in that we're both in general agreement that certainly the policies, the written document that Mike was talking about earlier on, I think should be disclosed to investors. I see no reason why that shouldn't be disclosed. I also see no reason why the bandwidths of hard to value, easy to value, and whatever it's in the middle, to use the new FAS 157 tiers, I think that they should also be disclosed to investors, because I don't see that gives away any proprietary information. Then you're getting down to a slightly different, it's not actually a valuation question, and it has an effect on valuation, but in terms of whether people give portfolio transparency or not is a sort of wider question, I think, where certain investors won't invest in a hedge fund unless they get full transparency, and certain hedge funds won't entertain investments where any such potentially market-sensitive information is given out. I think hedge funds sometimes pretend things are a lot more market-sensitive than they actually are, particularly in long-short equity. But I think, to answer the question, sorry, I waffled on a bit, the first one I think full, the second one I think partial, in the sense that I want a reasonable understanding of how much of that book was hard to value, and for example how much of it was priced off broker quotes, if that was being done, or off models. When it comes to positions, I mean, we'd love full transparency, but we're not always going to get it. So limited with the answer there.
Mark?
Well, like any investor, you ask an investor, do you want more information or less? And they're going to say, of course, I want more information. But what we look for is, we look for full on the first 2 and partial on the third. We like to get full transparency on the positions so we can do holdings-based analysis as well as returns-based analysis, but we don't always get it. So we're willing to settle for partial transparency on positions and full transparency on the first 2.
Mike, I know you want to answer, but I need to ask Mark a question first. Mark, didn't you write an article once upon a time, post-LTCM 1998? And did you not write in that article that what good would it have done had the investors had all the positions? Have you backed off from your view?
Yeah, indeed, I did write an article about 4 or 5 years ago where I did a partial analysis on LTCM, and I forget the number of positions they had on their books at the time they were rescued, but it might have been something like 100,000. Maybe even that was conservative. What investor can truly digest all that? Certainly at that time, I was the chief investment officer at CalPERS. We did not have a risk system sophisticated enough to digest that. So giving us that information would have been worthless to us. We wouldn't know what the heck to do with it. Nowadays, though, 5 years forward, at least at Hermes, we have risk systems sophisticated enough that we can take in a huge amount of data like that and do our own analysis. So if you can handle the data and you can use it legitimately and intelligently, why not ask for it?
Mike?
Sure. I mean, I guess I'd go with similar answers. I would say full on valuation policies, practices, and procedures. I would have probably said partial on the second point, and partial on positions. I mean, I think the position one is a challenging one for the reasons that Mark described. I think there's a question about what people would do with it if they ever got it, and whether that's really, the raw data is really the most useful information as opposed to the analysis of the data, or actually information as opposed to data, whether that's more useful to investors. So I do think there's a trade-off between transparency and independence. So going back to the valuation point, I think to the extent there's less independence brought to bear on the valuation, I would argue that you should have more transparency over that process, and I think that's to me a reasonable trade-off to have. The other thing I would say is that the issue of transparency doesn't just affect investors. There's some new audit requirements that are actually requiring auditors to request full portfolio detail in connection with audits of entities that invest in alternative investments like hedge funds, and there's quite a bit of controversy around that for endowments and other large institutional investors that may not have coterminous year ends with the funds in which they invest, and so it is a very hot topic these days.
Mark, when you were at CalPERS, when was the year end? December 31st or March 31st?
For CalPERS, it was a fiscal year, a California state fiscal year ended June 30th.
June 30th. So what did CalPERS do when it received, when it had to go ahead and value its books as of June 30th, but it made investments in funds that no doubt virtually everyone had a year end of December 31st. When the audit took place, you relied on maybe less rigorously marked portfolios as of June 30th. How'd you deal with that?
You deal with it however you can. You raised the perfect point. We had a fiscal year in California that lacked synchronicity with most hedge fund managers who use a calendar year base. So we had audit reports as of 6 months ago, and then we simply had to rely on our own due diligence to ensure that the marks we were getting through the new 6 months were consistent and sufficient with what we saw at year-end audit.
So the firms like Price Waterhouse, who were auditing pension plans or universities that have June 30th year ends, would not be relying on audited financial statements, Mike?
Audited financial statements, the most recent audited financial statements would be one piece of audit evidence that an auditor would use in auditing a portfolio of alternative investments. But consistent with this new guidance, which people are referring to as AU 332, the auditor needs to first, frankly, focus on what Mark said, which is essentially the organization's due diligence and monitoring processes and procedures. And rather than just rely on information that they get from the auditor of investee fund, they really need to look at the initial due diligence that's done by the investor. They need to look at the ongoing monitoring that's done at the investor level. They need to look at the financial reporting controls at the investor level and as well as the degree of transparency that's provided and other information in auditing that entity.
David, do you really believe that the effort made by fund managers on June 30th to come up with evaluations is as rigorous as on December 31st when they're going to be audited?
This is where, we've seen somehow to have forgotten or underemphasized the role of the administrator, and I think that's where people who favour the administrator being involved would point to that being important, because lots of funds say to us when we're looking to invest in them, we've been through 8 audits and we're registered with the SEC. Well, so have several Ponzi schemes that failed mid-year. And what you're trying to achieve, most hedge funds have monthly liquidity points or certainly monthly pricing points. You want that formal NAV. Obviously, it's not going to be have a certified audit performed upon it every month, but you want that process.
Wait, Mike wouldn't mind that, though.
I actually would. We're busy enough. Thank you.
But you want that process to be as formal and consistent as possible. So that's where I think if you have an administrator who certainly, of course, will not be competent in a complex portfolio to value it all, but who has a process and a procedure and a sort of escalation and arbitration process on difficult positions. You want.
But do you believe that's going on, David? Do you
I
really
think
believe that it's
I
as
think
robust?
I think it does in certain funds, and I think
in certain firms.
What due diligence can an investor do month to month? I don't think any hedge fund. There are obviously these platforms where people get full transparency. I'm afraid most of the prettiest ladies tend to keep themselves buttoned up and just won't give you that. So you could go down that route, but you'll be not getting access to 40 or 50 of the best funds in the world if you do that, and that's your decision. If you don't do that, I can't see how an investor can do meaningful due diligence on the sort of procedures at a fund manager, but he's got no guarantee that there is any independence at the month-end process, and that's why I think there is a movement. Now, you can take a step back and be cynical about how much the administrators actually do. We actually visit the administrators, and they're very variable in quality. But at least having that process on a monthly basis, or if the fund is self-administrating, having a valuation committee, preferably with an independent member on it, is going to give you more comfort. It's not just a question of fraud in intra-year, it's also a question of, as I say, smoothing and getting out at the wrong price if you're an investor who's redeeming.
Is Andrew Lowe still here? He left. In 2002, Andrew co-authored a study on on hedge funds, and he concluded that because they have illiquid securities, that the reported returns tend to be smoother than economic returns, and therefore it understates volatility, increases risk-adjusted performance measures such as the Sharpe ratio, which would suggest then that the intra-year process is not as rigorous or as robust.
Well, I
And
mean,
then-
I can think of some funds who, to be fair, have very complex portfolios, who I think probably have a sort of firmer stab at fair valuing at half-year end and year-end. And, at quarter ends, I would say their NAV is less reliable.
And then there's one other I want to share with you. The Center for International Securities and Derivatives Markets compared the results of the HFRX, which is a hedge fund index, to the S&P 500, and it found a 0.77 correlation using monthly data and 0.53 correlation using daily data. I mean, does that suggest to you that the valuation procedures might differ during measuring periods, or perhaps year-end is stronger than monthly, or a monthly stronger than daily?
Well, monthly is definitely stronger than daily, because some of these instruments, frankly, they're just not spending the time and effort to value on a daily basis, because there's really no point for them to do that. I mean, I would tell you that I think there is no way to absolutely verify it, as David is saying, but I would tell you that as a function of an investor's due diligence, they would spend a lot of time understanding what the monthly valuation process is, and not only asking questions, but actually doing some testing and looking at monthly reporting packages that support monthly valuations to get comfortable with the robustness of the process during the year.
Now,
it may not be the same, frankly, just psychologically, because you know that an auditor is not coming in to challenge you, and so the extent to which they document that may differ.
Isn't there a footnote in the audit financial statements that might tell you what the monthly results were? Do you never see that?
No, there is no. I mean, the
I've seen that.
The audit is dealing with the period under audit, which is the year.
But that will include subscriptions and redemptions into the fund during the year, so you will be looking at that.
Yeah, but you're not reperforming or verifying or substantiating the valuation of the portfolio or any other assets and liabilities, frankly, on a monthly basis. You're doing, an audit by definition is as of a snap. The balance sheet is a snapshot in time, right? So you're doing it as of 12/31, let's say. You are looking at their policies and procedures and controls during the year, and you are looking at monthly closing packages, but you're not substantiating or repricing the portfolio generally in any frequency other than the annual date, unless they've asked for some additional work through reviews or what's referred to as agreed upon procedures.
So here's how you voted, by the way. 83% wanted full transparency with regard to valuation. 51% wanted full with regard to the performance attributes, and 67 only a limited. 67 asked for a limited report on positions. Our last polling question is, should investors sit on a valuations committee? And I guess we'll start with Dr. Anson.
Throwing away my title of doctor, I'm still a lawyer. And when I see a question like this, I think, gosh, would I as an investor want to sit on an evaluations committee and open myself up to a lawsuit from other investors? No, I wouldn't do that. Who should sit on the valuations committee? Well, certainly I think within the hedge fund, they should develop some independent people who can sit on that valuations committee, i.e. risk manager, independent chief financial officer, independent director from the board. So should investors sit on valuations committee? Well, certainly not me, but God bless anyone else, any other investor out there who wants to do it.
Mike?
Yeah, I mean, I'm not sure I can answer the specific question. I think the more independence there is in the process, the better. And again, you have to define independence more broadly than I think you'd frankly like. What I find interesting is, and I know they're very different, but if you compare hedge funds and private equity funds actually have as a standard governance element an LP advisory committee, and so it is standard practice for a group of large investors to sit on an LP advisory committee, which, among other things, actually is responsible for approving the valuation. And so I know it's a different structure, and they're the same investors from day one to the liquidation of the fund. But I have always found it interesting that has always been the case for a private equity fund and is never the case for a hedge fund.
Because in a hedge fund, there might be inside information, because investors can go in and out. I think Mark wants to respond, and then we'll go to you, David, after that.
I've sit on a number of advisory committees for limited partnership agreements, and you have to be very, very careful when you sit on those advisory committees in private equity funds. If you start to do something that could be perceived as a general partner duty, you break the firewall between you as a limited partner investor and stepping over that firewall to now become a general partner of that private equity fund. So you've got to be very, very careful. All jokes aside about being a lawyer and who you're going to sue, keep in mind that one of the things that protects you as an investor in a hedge fund or a private equity fund is your limited partnership status. You start to become too actively engaged in that fund, you will break that firewall.
David?
I think that's right, and also there are sort of most favoured nation or status issues there. If one investor sees, which he inevitably will, if he or she is sitting on that committee, will inevitably see more information than other investors. But I think that some independent person ideally should sit on that committee. I know they're hard to find, but I don't think a risk officer from the firm or a CFA from the firm is independent. And I think this is what troubles regulators more than anything else, that in hedge fund managers take the substantial portion of their fees on the basis of unrealized gains, and that if there's no independent presence there to manage that conflict of interest, that is a concern to regulators, which is why in the industry we're writing these papers trying to find some way of dealing with that process without wasting hedge fund managers' time and investors' money.
But it doesn't seem to concern investors because they keep investing in hedge funds.
It concerns people, I have to say, investors who go into offshore funds. We're a European fund of funds, so we would never invest in a general partnership where there is absolutely no, in many cases, absolutely no independent oversight of these things. Now, you can be sceptical about how much administrators and offshore directors actually do, but at least they're doing something, because if they're not doing anything, they're liable to be sued in quite sharp fashion.
Here's how you voted. It was a split, 51 to 49. Does anyone in the audience have any questions for our distinguished panelists? Yes, we have a question. Microphone, please. If you don't, I have plenty more.
Hi, this is probably for David and Mark, as you guys have had lots of experience allocating in the hedge fund space. You've mentioned on a couple occasions that you would outright not invest with funds that don't pass certain standards, whether it's valuation procedures or other operational type issues. Can you just give us a sense as to what the percentage of funds that you guys have looked at over the years don't meet at least a minimum acceptable standard? Is it pervasive in the industry, or is it a very small percentage?
I'd say about a third of the ones just do not meet minimum requirements we would accept for investing in a hedge fund. And then you narrow it down, another third get thrown out, either because the return stream is not as robust as you might like it to be, or it doesn't blend in. And then you get down to the third remaining that are potential candidates for building your investment portfolio.
It depends what your standards are, of course, but I would say that's about right. I think that there are a third of funds where if you just look at the basic documentation, in 10 minutes you feel that there are issues there, be they valuation issues or other issues or issues connected to the trustworthiness of the principles, where you cross them out in 10 minutes. And then there's probably a subset further on where when you do more work you cross them out for the same reason. So, sorry.
Just a quick follow-up. Any common characteristic of the ones that you would not invest with? Is it size, or is it the smaller managers per se?
I would start, one of the consistent and persistent characteristics is lack of operating structure. Every hedge fund manager out there believes that he or she has a great investment idea, and most do. But where they begin to fall down is the infrastructure they need to support that investment idea. we've talked about a lot today, and just valuations alone, we've had one whole panel on this. You can go on and on and on about risk management and all the other issues. So there's an awful lot there.
The research says 50% of hedge funds fail for operational reasons of some kind. Hedge funds that fail, and I wonder whether the figure might even be higher. And certainly one portion of that is people who can maybe run a portfolio but just can't run a business properly, and for all sorts of reasons the business fails, be it because they've hired up jerks in the back office or they can't raise assets or whatever. But I think also we find there was a correlation between sort of economy with the truth by the principles of hedge funds. People who aren't straight in sort of material ways tend then to do unstable things in their portfolio. So I think we look for people to be straight and to try and organise themselves. No one can be fair to everybody in this business, but to try and organise themselves in an equitable way and not have material conflicts of interest.
Question right in front. Down here.
I have a quick question.
Oh, okay.
I'm way in the back. Is there, in the formation of a hedge fund and in agreements with investors, there's an awful lot of lawyers employed. Is there a clear definition as to who is legally responsible for the valuation of the fund's inventory?
I think in an offshore fund, certainly, it would normally state that the ultimate responsibility rests with the directors of that fund. And for an onshore fund, a limited partnership, I think it would be fair to say that it should, almost always, the memorandum will say that the general partner is responsible. It'll also give the general partner lots of wit to use his discretion, but it will almost always state that in a memorandum, and if it doesn't state it, it should.
I'm still waiting to read a document that says the prime broker is responsible.
Has anybody seen one that says the funds administrator is responsible?
Well, I think there may have been a few of those in the 1990s, but fund administrators' lawyers won't let them say that now. But off the record, I think some administrators accept the fact that if they have because they're only held harmless for normal course of business things. If they've been grossly negligent, I think they would expect to get sued, and often are.
See, in their marketing pitches, the administrators say, we can do the valuations, we can do it as well as anyone else. And then when you ask the administrators, as I have, would you accept legal responsibility? Then the answer is no, we don't do that. So I'm not sure how. Pardon?
They absolutely cannot do the valuation in many cases. So it's curious that it's implied that they can, but it's only implied, I guess is my question.
Well, I think that's a very good question, in the sense that I think it is a grey area, in the sense that I've been... The question of, do administrators actually think they're taking legal responsibility? And in those situations where the administrator does a lot of work, who amongst all the parties thinks is actually going to get hit for six, to use an English expression, if things go wrong? And, I mean, that is an interesting point, in that we put a lot of emphasis on a strong administrator, but would we actually see them?
And they get paid for by the investors, right?
They're paid for by the investors, in the sense that they would normally charge, 20 basis, customary fees, which I don't think are unreasonable. But of course, some of the administrators turn around and say, if you want me to be on the line for producing a crisp NAV that is consistent month on month, I need to have more money. I mean, it's an unenviable business in that sense, and it's low margin, and of course they have to deal with very high turnover of staff. But that's an important point in terms of the legality of it, which is I think sometimes a grey area for offshore funds.
Thanks.
Some more questions? Yeah. Can we have a microphone over here, please?
Question for Mark.
And then we'll bring it down after that.
You said that you generally strive for full disclosure valuation policies and full disclosure on exposures, and try to get partial on positions. You also said that you're looking for, you wouldn't invest if the fund didn't give you, good notice about side pocket information and ground rules and so forth. Now, let's say Jim Simons opens up Medallion for you, and he's not going to give you any of these things. What do you do?
I'd still ask him for it.
Oh, he's not. You're welcome to invest. I mean, he's opening up the fund. He's not going to give you these
I'll give you
things.
another example of another extremely well-known hedge fund that I was offered to invest in. I won't name it. A few years back for CalPERS. And in fact, I sat down with their famous general partner at the Parker Meridian about 3 years or so ago for breakfast. He refused to give CalPERS some basic, I'd call them basic governance with regard to the things we've talked about today. And I declined flat out to invest. Now, you can say I was dumb because he was a great investor, still is a great investor. But at the end of the day, I have to protect the portfolio. And if I can't turn around and assure my client that I'm doing that, then I have to look in the mirror and realize that there's sometimes you just have to pass an investment by, even if it's the best damn investment in the world.
Well, first of all, it's Medallion, and also everyone else is going to take up this opportunity. You don't have the idea that you could limit, let's say, a small percentage of your fund of funds to allowing for this type of illiquidity or lack of knowledge? You couldn't live with that.
To your
kind of
point,
situation?
just to cut it off, because I know we're going to run out of time, this fund is better known and has better returns than Medallion that I turned down.
I believe that there was an article in the business section of the Times a couple of weeks ago. David Swenson was an article about David Swenson from Yale. If I'm not mistaken, I think Swenson said that they didn't show him the information, he refused to invest, and he doesn't feel bad at all about it.
But, all right, zero tolerance, that's perfectly acceptable, or defensible position of a fund. But so would be the idea that you would allow for some percent of your book to be, legitimately unknown. Certainly there's unknowns in terms of positions. We don't have the ability to measure risk in that manner. Have you done an actual study that shows the trade-off between valuation, full disclosure and valuation versus the potential impact, or the potential risk in the fund?
But would you be saying this if you were in a fund of hedge funds where 3 of the funds had blown up, where you'd been in Amaranth and in Buy? That wasn't necessarily valuation, but...
We're saying, obviously you have to live with some unknowns in this world.
But
the question is whether zero tolerance policy is as effective or is as appropriate, for your long-term interests or the interests of your investors versus, allowance to some degree. I think the only way that could be solved would be actual study to see what the impact is.
Sorry to interrupt. I think we're not talking about zero tolerance of unknowns in portfolios.
With valuation policy, you are.
We're talking about zero tolerance of people not giving us basic information. So, for example, if, in the case of Medallion, to take that example, if I was given no idea or no indication of what in that portfolio was hard to value and what was easy to value and how they did it in principle, then I think that is fair not to proceed, because no sensible person can do that.
I'm afraid I'm going to have to cut off the discussion, but I'd like David to please hold up the AIMA guide so people can see at least what it looks like.
Yeah.
It's a terrific document just published by AIMA. It's a guide to hedge fund valuations, and David was the chair of the group that worked on it. Mike worked on the IOSCO document. Do you have a copy of that with you, Mike?
No,
to hold up?
I don't. I'll take the opportunity to hold up a different publication. If anyone on the investor side is familiar with this AU 332 issue, which is given your auditors all sorts of fits dealing with auditing investments in other funds, PricewaterhouseCoopers has a monograph on that subject, and I'd be happy to send it to you if you give me your business card afterwards.
And Mark, is there anything you want to hold up besides your suitcase?
No, I don't want to hold up anyone.
So since we don't want to hold up anyone, let's give a round of applause to our panelists.